Dow Jones, that grand numerical puppet show that Wall Street uses to convince us all that squiggly lines on a chart somehow capture the essence of human prosperity. It's rather like measuring the health of an entire forest by watching how three particularly loud trees sway in the wind. Not in the number itself, but in how we gather round it like ancient augurs examining entrails, convinced that these arbitrary mathematical gyrations hold the secrets to our economic future. When it rises, champagne flows in penthouses. When it falls, pearls are clutched in boardrooms. Yet somehow, the person serving the champagne's salary remains stubbornly unchanged either way. Isn't it delightful how we've collectively agreed to treat this industrial-era relic like an oracle, despite it representing about as much of the modern economy as a horse-drawn carriage represents modern transportation? The Dow Jones Industrial Average, a name so wonderfully misleading it borders on satirical art. Industrial. In an economy where the biggest companies trade in clicks, likes, and digital ephemera, average. There's nothing average about a mathematical formula that gives different weights to stocks based purely on their nominal price, like judging the importance of books by the thickness of their covers. It's the economic equivalent of measuring a nation's literacy by counting how many people are holding books in public, regardless of whether they're reading them upside down. Not in its accuracy, of which there is precious little, but in its ability to transform complex economic realities into a single number, a number that serves as a daily dose of financial soma for the masses. Not because it accurately measures anything, but because we collectively decide to act as if it does. It's rather like a theatrical production where the audience's belief in the performance becomes more real than the performance itself. And yet, this numerical pantomime has real consequences. Retirement accounts rise and fall on its whims. News anchors breathlessly report its every hiccup as if reading sacred texts. Algorithms trade billions based on its movements, like elaborate automated responses to a grand game of Simon Says. The magnificent evolution. What began as a humble attempt to simplify has become the grand emperor of economic indicators, proudly wearing clothes that don't exist. It's a bit like using a Victorian-era thermometer to measure the temperature of the internet. Charming, perhaps, but horrifically inadequate. The true mastery of the Dow lies in its perfect embodiment of Goodhart's law. When a measure becomes a target, it ceases to be a good measure. Yet here we are, in an era of high-frequency trading and complex derivatives, still genuflecting before a number that would be perfectly at home in a steam-powered calculator. But here's the truly transcendent part. It doesn't just measure our financial delusions. It's become a metacognitive mirror, reflecting our desperate need to compress the incomprehensible complexity of global finance into a single, digestible number. It's rather like trying to understand entire human experience by measuring only the height of people named Jones. The Dow has become less a measure of industrial might and more a daily reading of our collective economic mythology, a shared hallucination so powerful it can move billions of dollars with a single digit's change. In this light, it's perhaps the most successful piece of performance art in history, an interpretative dance of numbers that we've all agreed to pretend makes perfect sense. The Dow isn't merely a flawed measure. It's a perfect crystallization of our collective cognitive dissonance about wealth itself. Think of it as the emperor's new clothes, but with a clever twist that everyone gets a small commission for pretending to see the fabric. How it serves as both instrument and alibi. When the number goes up, it's trumpeted as proof that the system works. When it plummets, it becomes the very emergency that justifies extraordinary interventions to protect the system. It's rather like having a weather vane that somehow justifies both sunshine and storms while measuring neither. The more meaningless it becomes as an economic indicator, the more meaningful it becomes as a sociological one. We stare at its movements and see whatever confirms our existing beliefs about capitalism, wealth, and power. It's become too big to question. It's simultaneously meaningless and all-important, irrelevant and crucial, outdated and timeless. It's the perfect metaphor for modern capitalism itself, an arbitrary system we all agree to believe in because the cost of disbelief is too high to contemplate. The Dow isn't just a number. It's the world's most successful promotional campaign masquerading as financial wisdom. It's the original meme stock, if you will, But instead of Reddit fueling its relevance, it's got the entire financial establishment. Every day, millions of dollars move based on this index that would have been considered mathematically absurd even by 19th century standards. 3M's stock price carries the same weight as United Health Group's in the index, despite United Health having more than twice the market capitalization. It's like saying your pet goldfish and a blue whale should have equal votes on ocean policy because they both swim. Its flaws are features, not bugs. When the market needs to look healthy, a few high-priced stocks can drag the whole index up, creating the illusion of broad prosperity. When it needs to look troubled, say, to justify certain policy interventions, those same stocks can create the appearance of crisis. Think of the Dow as a theater production where everyone has their role to play. First, the stage managers. S&P Dow Jones Indices LLC, a joint venture between S&P Global, the CME Group, and News Corporation. They literally make money by licensing this mathematical relic. Every financial product that tracks the Dow, every data feed that displays it, every reference to it, ka-ching. They're selling tickets to a show that never ends. The performers, the financial media, CNBC, Bloomberg, Reuters, they need simple narratives for complex markets. Dow up 200 points is much easier to sell than complex interplay of global economic forces creates marginally higher asset valuations in certain sectors. They're not just reporting the theater, they're part of the performance. The stagehands, investment firms creating Dow-based products. ETFs, futures, options. Each derivative creates new revenue streams, new trading opportunities, new ways to charge management fees. It's like selling merchandise at a concert, but the concert never ends, and the t-shirts are made of mathematics. The Index Committee, yes, that exists, meets regularly to decide which companies are industrial enough for the industrial average. Apple. Sure. Boeing. Of course. It's like casting a play where the only qualification is that the actor must be willing to pretend they're in a different play. When stock price gets too high or low, threatening to expose the absurdity of price weighting, they simply adjust the Dow divisor, a number that's been adjusted so many times it's about as industrial as a smartphone. Each morning, financial advisors worldwide open their client meetings with the Dow was up/down, not because it's meaningful, but because their clients expect it. It's become a ritual, like checking your horoscope, but with more decimal points. The chief beneficiaries, beyond the obvious players. Policymakers who need simple metrics to justify complex interventions. Large institutional investors who can move these 30 stocks more easily than the broader market. Corporate executives whose compensation is often tied to stock performance and who doesn't want to be in the Dow. Anyone who benefits from the status quo of financial markets because the Dow has become shorthand for everything is normal. But perhaps the most brilliant beneficiary is the financial system itself. By maintaining this easily manipulated, mathematically nonsensical index as the face of the market, it creates an illusion of simplicity that masks the true complexity and vulnerabilities of modern finance. The 2008 performance, Too Big to Fail, the musical. During the financial crisis, the Dow performed its greatest magic trick yet. It became both the measure of the disaster and the measure of the recovery. On September 29, 2008, it dropped 777.68 points, its largest single-day point drop at the time. The headlines were deliciously apocalyptic. But here's the sleight of hand. The Dow wasn't reflecting the crisis. It was helping choreograph the response. When the Dow plunged, it created the perfect visual narrative for emergency intervention. Those falling numbers on screens worldwide became the equivalent of financial terrorism alerts. See? We must act now. The index that was too flawed to accurately measure the economy somehow became accurate enough to justify trillion-dollar bailouts. Even more masterfully, as the recovery began, the Dow's price-weighted absurdity became a feature. The heavy weighting of financial stocks meant that as the bailed-out banks recovered, the index looked healthier than the actual economy. It was like measuring the health of a hospital by only checking the pulses of the doctors. The digital age adaptation. Silicon Valley joins the cast. Now this is where it gets properly farcical. The Dow, born in the age of telegraph machines, had to adapt to an economy run on semiconductors and cloud computing. Their solution: just add tech companies. Apple joined in 2015, making an industrial average that now tracks your iPhone. The digital age brought high-frequency trading, where algorithms trade Dow-based products in milliseconds, creating a recursive loop of cause and effect. But the true masterpiece of the digital age adaptation is how the Dow survived the rise of far more sophisticated measures. In an era where any smartphone can calculate complex market-weighted indices in real time, the Dow's primitive mathematics should have been its death knell. Instead, its very simplicity became its strength. It's the comfort food of financial indicators. The synthesis of these eras reveals the Dow's ultimate evolution, from a measure of industrial might to a measure of narrative control. In both 2008 and the digital age, it proved more valuable as a storytelling device than as an economic indicator. It's no longer measuring the market. It's measuring our collective belief in the market stories. And now, in an age of meme stocks and cryptocurrency, the Dow has achieved its final form. It's become the boomer meme of financial indices, outdated, oversimplified, but somehow still influencing the broader cultural conversation about money and value. The next crisis won't come from mortgages or tech bubbles, but from something thoroughly modern. Perhaps quantum computing breaking cryptography, or AI systems briefly seizing control of trading algorithms. The Dow, in its magnificent obsolescence, will likely be the last indicator standing precisely because it's too primitive to be directly affected. Like a sundial during a power outage, it will suddenly seem wise in its simplicity. It will once again perform its dual role, first as harbinger of doom, dramatic plunge, then as the phoenix of recovery, triumphant rise. But this time, with a twist. In a world of deepfakes and AI-generated realities, the Dow's very anachronistic nature will make it seem more real. It will be like finding a Nokia 3310 in a world of compromised smartphones, suddenly valuable because of its limitations. The Dow's continued relevance is perhaps the greatest magic trick in financial history. Every business school professor explains why it's flawed. Every sophisticated investor knows it's meaningless. Yet it persists, like a financial cockroach surviving every extinction event. Why? Because it's become something far more powerful than a market index. It's become a shared mythology. Like the Oracle of Delphi, its power lies not in its accuracy, but in our collective agreement to act as if it matters. The more complex finance becomes, the more people cling to its simplicity. It's comfort food for the financial soul, the grand finale, the ultimate truth. And here we arrive at the magnificent punchline of this century-and-a-half-long joke. The Dow Jones Industrial Average has transcended its role as a market indicator to become something far more profound, a mirror reflecting our desperate need to believe we can measure the immeasurable, control the uncontrollable, and predict the unpredictable. In a world increasingly divided by competing narratives, the Dow remains one of the last pieces of financial theater we all agree to believe in. It's not just surviving despite its flaws. It's surviving because of them. Its very absurdity has made it indestructible. Like a Broadway show that's run so long nobody remembers why it started. It continues because it continues. The Dow isn't just a number. It's become a meta-commentary on the entire financial system, an arbitrary measure of arbitrary values, given meaning by arbitrary consensus, moving markets through arbitrary decisions, all while we pretend there's nothing arbitrary about it. And perhaps that's the true genius of the Dow Jones Industrial Average. In a world of increasing complexity and sophistication, it stands as a monument to our enduring ability to collectively believe in something we all know isn't quite real. It's not just measuring the market, it's measuring our capacity for shared delusion. And isn't that, in the end, what finance is all about? The curtain falls, but the numbers keep dancing. Up, down, up, down, up, down.